Hi, I'm Yolanda Naudé. I'm responsible for fund research with a small team at Citadel Asset Management. In the asset management industry, we typically find three different approaches to money management. The first of which is the so-called active approach, and this is typically where a money manager would take active positions away from a specific index or benchmark in order to achieve outperformance of that index. The complete opposite of this is passive investment management, where a manager would typically mimic a specific benchmark or an index in terms of the specific characteristics of that benchmark. And then of late, over the past couple of years, we've seen a significant increase in the so-called smart beta, fundamental, factory investing, alternative beta kind of space, where a money manager would typically use a more strategic, statistical, mechanical approach of constructing a portfolio where they aim to outperform an index but with lower fees than active managers. Now in 2014, we've seen a significant underperformance by active managers. Only about 10% of the large cap core equity managers in the US have outperformed their own benchmarks in 2014. And on top of that, Morningstar has indicated in their research that about 80% of global equity managers and about 50% of global bond managers did not beat their benchmarks in 2014. Now the question surely is, why did this happen? In our book, there's about 5 reasons for this. You typically find active managers doing very well when you have an environment of high dispersion of return, high volatility, and low correlation. And dispersion of return is literally referring to the extent to which the biggest and the largest performance in a specific index or a sector or a country, the difference between the best and the worst. Volatility is indicating price movement, the extent to which prices move up and down, and correlation, the extent to which things move together, up or down. Now, active managers absolutely enjoy an environment of high dispersion, high volatility, and low correlation. And we've seen the complete opposite of that in 2014. On top of that, active managers also typically do fairly well when small caps outperform, because they tend to have a bias to this part of the market, which is typically under-researched. In 2014, small caps have underperformed their large cap counterparts by the most in about 15 years. So that contributed to active managers not performing well in 2014. And on top of that, and lastly, in terms of reasons for underperformance, in 2014, if you were a global equity manager and you have had significant exposure to non-US equity markets, then if you measure your returns in US dollars, the significant strength of the dollar in 2014, where it appreciated 6% against the pound and about 14% against the euro, would have counted significantly against you. So these are the reasons for some of the reasons for the underperformance of active managers, but we do think that 2015 and beyond should be better for active managers. If low dispersion, low volatility, and high correlation have been part of the reason of the underperformance of active managers in 2014, then we do think that 2015 and beyond should be better. We've already seen significant divergence in the economic landscape, with America starting to think about hiking interest rates, whereas Europe and Japan are still absolutely busy with quantitative easing. This divergence in economic policy is likely to potentially also lead to divergence in market pricing. On top of that, we have sustained geopolitical risk at a high level, and on top of that, we have a variety of countries going into elections, and those definitely have uncertain outcomes in very many instances. On top of this, Nomura recently did very interesting research where they looked at the relationship between active managers and long bond yields, government bond yields. And the indication is that active managers typically do well when we have a rising interest rate environment. We've already seen a backup and an increase in bond yields internationally over the past couple of weeks. And we do think that this will create a better environment for active managers. We've seen this in 2013 when the then chairman of the Federal Reserve, Ben Bernanke, mentioned that they're likely to taper their stimulation program. As a result of this, bond yields internationally absolutely shot up and the prices came down. And this created a very fertile ground for active managers to outperform. So in short then, we do think that active managers should do better in 2015. We do think that the changing macroeconomic landscape is likely to lead to more divergence. We're possibly likely to see more and higher dispersion, higher volatility, and perhaps lower correlation than we've seen in the recent past. And on top of that, interest rate increases in the largest financial market in the world is likely to provide that impetus that global active managers have been waiting for so long.